Every single time gold is about to explode, the same three things happen first. Right now, all three are happening simultaneously, and most Americans have no idea what's coming. We're not talking about a 10% bump. We're not talking about a minor correction bounce. We're talking about the kind of move that turns a $50,000 position into $200,000. The kind of move that redefines retirement portfolios. The kind of move that, once it's done, people look back and say, the signs were right there, I just didn't see them. Well, today, you're going to see them. If you're watching this and you care about where your money is going, hit subscribe right now, because this channel is where the real financial conversations happen. No fluff, no noise, just the analysis that matters. And drop a comment below. Tell me, do you own gold right now? Yes or no? Because by the end of this video, your answer might change. Stay until the end, because the third signal we're covering is the one Wall Street hopes you never understand. Let's talk about what just happened to gold, because the numbers are genuinely shocking. In January 2026, gold hit an all-time intraday high of $5,095 per ounce. Let that number land for a second. 2 years ago, gold was sitting around $1,347. That's a move of over 200% in roughly 24 months. Now here's where most financial commentary gets lazy. They say, oh, it's inflation, or oh, it's war, and they move on. That's not analysis, that's noise. What the data actually shows is something far more structured, far more predictable. There is a sequence, a specific chain of events that has shown up before every single major gold explosion in modern financial history. And understanding that sequence is the difference between watching gold run from the sidelines and actually being positioned when it happens. So let's break it down, signal by signal. The first thing that always happens before gold explodes is this. The Federal Reserve either cuts rates, signals cuts, or completely loses credibility in the market's eyes. Every single time. Look at 2019. The Fed pivoted dovish, signaled rate cuts, and gold surged from $1,180 to over $1,550 within months. That's a 21% move, triggered almost entirely by a shift in language from the Fed, not even an actual cut yet, just the signal. Look at 2020. The Fed slashed rates to zero and launched the most aggressive monetary expansion in American history. Gold went from $2,500 in early 2020 to $2,075 by August, a new all-time high at the time. Look at what happened in 2024 and 2025. The Fed started its rate-cutting cycle in late 2024, and gold didn't wait for the cuts to stack up. It started moving the moment the pivot was confirmed. By April 2025, gold had already crossed $3,500. By October 2025, it crossed $4,000 for the first time in history, and by January 2026, $5,295. This is not coincidence. This is mechanism. Here's why this works. When the Fed cuts rates, real yields, meaning the return you get on bonds after adjusting for inflation, compress or go negative. And when that happens, the entire argument against holding gold collapses. Gold doesn't pay a dividend. It doesn't pay interest. But when bonds aren't paying you anything real either, suddenly gold's lack of yield isn't a disadvantage. It's irrelevant, and capital floods in. Now, where are we today in April 2026? The Fed is still navigating between stubborn inflation data and slowing growth. The market is skeptical of how many cuts will actually come. And that uncertainty, that tension between what the Fed says and what the market believes, that is historically one of the most bullish environments gold can exist in. Because when the Fed eventually has to capitulate, and the data suggests it will, gold will front-run that move. It always does. And look, that's just signal one. Signal two is the one that's currently happening at a scale that hasn't been seen since 1971. And signal three, the one we'll get to before this video ends, is the signal that the average American investor is most blind to and most exposed by. Don't go anywhere. Here's a fact that should stop you cold. According to the World Gold Council, central banks collectively purchased over 1,000 tons of gold in 2025, marking the second highest annual total ever recorded in history. These aren't retail investors. These aren't hedge funds chasing momentum. These are sovereign governments, nation-states, quietly, systematically, and aggressively pulling gold off the market. China, India, Turkey, Poland, even smaller nations like Uganda have launched programs to purchase domestic gold to build their reserves. This isn't a trend. This is a structural shift in how the world stores value. And here's what makes this signal so powerful. Central banks are not traders. They don't buy gold to flip it in 6 months. When a central bank buys gold, harsti pulveris, that gold goes into a vault, and it does not come back to the market, which means supply is being permanently removed while demand keeps rising. Morgan Stanley confirmed it. Gold surpassed the share of U.S. Treasuries in central bank reserves for the first time since 1996. Read that again. Central banks now hold more gold than U.S. government debt in their reserve portfolios. That's not a minor portfolio tweak. That is a vote of no confidence in the dollar as the world's primary reserve asset. And every time in modern history that central banks have made this kind of coordinated, large-scale move into gold, prices haven't just gone up. They've reset to an entirely new level. That's exactly what we're watching happen right now. So we've established two signals: the Fed pivot and central bank accumulation at historic scale. Both are live, both are active, both are pointing in the same direction. But signal 3, this is the one that hits different. Because this one isn't happening in some foreign central bank vault in Beijing or Ankara. This one is happening right here, in American households, in American retirement accounts, in the purchasing power of every single dollar sitting in your savings account right now. Signal 3 is dollar weakness, and what comes with it. Here's the raw reality. The U.S. dollar index, known as the DXY, measures the dollar's strength against a basket of major world currencies. In late 2025, it fell to around 98. That might sound like a technical number, but what it means practically is this: the dollar is buying less, globally, structurally, and potentially permanently. Now here's where it gets personal for Americans. Most people think dollar weakness is someone else's problem, something that affects traders or importers, but that's completely wrong. Dollar weakness is an inflation multiplier. When the dollar loses value, everything priced in dollars gets more expensive. Oil, food, electronics, housing, the inflation you've been feeling at the grocery store, at the gas pump, at the car dealership. Dollar weakness is one of the engines driving all of it. And what does gold do in that environment? It absorbs every dollar that loses faith in the system, every pension fund manager who looks at real yields and says, this doesn't work, every foreign government that looks at U.S. debt levels and quietly starts diversifying, every American retail investor who finally realizes their savings account is losing purchasing power in real terms. They all end up at the same door, and that door leads to gold. This is not theory. This is the pattern, and right now the pattern is screaming. Let's put some numbers on the table that most commentators won't touch. The United States is currently carrying over $34 trillion in national debt. The interest payments alone on that debt are now running at over $1 trillion per year, surpassing defense spending. That's not a fiscal footnote. That is a structural crisis developing in slow motion, and bond markets are starting to notice. When the world's largest economy is paying more to service its debt than to defend its borders, the confidence equation around the dollar starts to shift. JPMorgan's head of global commodities strategy, Natasha Kaneva, put it plainly. The long-term trend of official reserve and investor diversification into gold has further to run. JPMorgan is now forecasting gold to average $5,055 per ounce by the final quarter of 2026, rising toward 5,400 by end of 2027. Wells Fargo has a target range of $6,100 to $6,300. Goldman Sachs sits at $5,400. These aren't fringe predictions from gold bugs on the internet. These are the most powerful financial institutions on the planet, and they are unanimously pointing up. Now let's pause for a second, because this is important. Gold already pulled back sharply after hitting $5,595 in January 2026. It corrected down toward the $4,000 range by mid-March. And when that happened, a lot of retail investors panicked. They thought the rally was over. They thought they missed it. That thinking is expensive. Van Eck, one of the most respected names in commodity investing, addressed this directly. They noted that in both prior major gold bull markets, there were 5 corrections of 10% or more along the way. 5. The recent pullback was only the second such correction in this current cycle. Meaning, historically, we are nowhere near the end of this move. The corrections aren't the story ending. They are the story reloading. Think about that. If you were invested in gold during the 2000s bull market and you sold every time there was a 10 to 15% pullback, you would have missed gold going from $250 to $1,700. The people who understood the macro picture held through the noise, and they were rewarded in a way that no other asset class delivered in that decade. The same dynamic is playing out right now, just at a larger scale, with more institutional participation, with more sovereign demand, and with a macro backdrop that is arguably more structurally bullish for gold than any point in the last 50 years. Here's another angle most people are sleeping on: ETF inflows. In the week leading into December 2025, gold ETF inflows exceeded $685 million in a single week. That's not retail investors buying coins at a local dealer. That is institutional money, funds, family offices, asset managers, moving significant capital into gold exposure in a compressed time frame. And central banks simultaneously purchased over 1,000 tons year-to-date at that point. When institutional money and sovereign money are moving in the same direction at the same time, that is not something you fade. That is something you respect. And there's one more layer here that ties all 3 signals together. And it's the layer that the average American is most dangerously unaware of: de-dollarization. The world is not abandoning the dollar overnight. Nobody is saying that. But what is happening quietly, methodically, across dozens of nations, is a slow-motion rebalancing away from dollar-denominated assets as the dominant form of reserve storage. And gold is the primary beneficiary of every dollar, literally and figuratively, that moves out of that system. Morgan Stanley confirmed that gold has now surpassed U.S. Treasuries in central bank reserve portfolios for the first time since 1996. That crossover is not just a data point, it is a declaration that the global financial system is hedging against the very instrument, the U.S. dollar, that has been the foundation of global trade for 80 years. When that foundation starts to crack, even slightly, the reverberations show up in gold prices first, before they show up in your mortgage rate, before they show up at your supermarket, before they show up in your 401k statement. Gold is the early warning system, and right now, it is warning. 3 signals, all active, all pointing in the same direction. The Fed pivot in motion, central banks hoarding gold at historic levels, the dollar structurally weakening under the weight of $34 trillion in debt. And the question every person watching this needs to answer for themselves is not whether gold is going higher. The data on that is overwhelming. The question is, what are you actually going to do about it? Let's talk about what the smart money is doing right now. Because the gap between what institutional investors are doing and what everyday Americans are doing with their portfolios is striking. And that gap is exactly where wealth transfers happen. Goldman Sachs has a 2026 price target of $5,400 on gold. UBS is at 1400, HSBC is averaging around $5,000. Wells Fargo went as high as $6,100 to $6,300. And JPMorgan, the largest bank in the United States, is forecasting gold to push toward $5,055 by the fourth quarter of 2026 and $5,400 by end of 2027. When you see that kind of institutional consensus with that kind of conviction from that many major players simultaneously, that is not noise. That is a coordinated read of the macro environment. And the macro environment is telling a very clear story. Now here is something that needs to be said directly, because too much financial content skips this part. Gold is not a get-rich-quick trade. It is not a meme stock. It is not crypto. Gold is a macro hedge. It is the asset you hold when the system around you is under structural stress. And the reason it explodes periodically, rather than grinding higher slowly every year, is precisely because most people ignore it until the stress becomes impossible to ignore. By then, the move has already happened. The people who studied the signals, who understood the pattern, who positioned early, they captured the return. Everyone else chased. Right now, we are still in the positioning window, but that window does not stay open forever. Let's get specific about where gold stands today in April 2026 and what comes next. After hitting $5,055 in January, gold corrected sharply, falling into the $4,000 range by mid-March. That correction shook out weak hands. It generated headlines about a gold bubble bursting. It made retail investors nervous. And institutionally, it was treated as a buying opportunity. Because the underlying drivers didn't change, not one of them. The Fed is still caught between inflation and slowing growth. Central banks are still buying. The dollar is still structurally challenged. De-dollarization is still accelerating. And now, after the correction, gold is rebuilding its base. Technically, analysts are watching the $4,600 to $4,700 range as a critical support and launching zone. A sustained break above $4,800 sets up a retest of the January highs. And if JPMorgan's thesis plays out, a push toward $5,000 and beyond by year-end is not just possible. It is the base case. Here is the part that directly affects everyday Americans, and this is where it gets uncomfortable. The average American household has the overwhelming majority of its wealth tied up in three things: their home, their 401k, which is predominantly in equities, and their savings account. That is an enormously concentrated bet on U.S. dollar-denominated assets in a world that is actively diversifying away from U.S. dollar-denominated assets. That is not a judgment. That is a structural vulnerability. Financial advisors have historically suggested a 5 to 10% allocation to gold as a portfolio hedge. But here's what's interesting. Given the current macro environment, names like Ray Dalio, the founder of Bridgewater Associates, and one of the most respected macro investors alive, has been publicly vocal about holding gold as a core position in a world of rising debt, currency debasement, and geopolitical fragmentation. These are not fringe views anymore. These are mainstream institutional positions. And the mechanism for everyday Americans to access gold has never been easier. Physical gold, coins, and bars, through reputable dealers. Gold ETFs like GLD or IAU that trade exactly like stocks inside your brokerage account. Gold mining stocks that offer leveraged exposure to the gold price. And for more sophisticated investors, gold futures and options. The access point is not the barrier. The knowledge of why and when, that is the barrier. And that is exactly what this video has been breaking down. Let's close with the single most important concept in this entire conversation, because everything else flows from it. Gold doesn't go up because people suddenly fall in love with a shiny metal. Gold goes up because confidence in the alternative, paper currency, government debt, central bank credibility, goes down. Every single major gold explosion in history has been a confidence event, not a gold event. In 1971, Nixon ended the dollar's convertibility to gold, confidence event. Gold went from $35 to $850 over the next decade, a 2,300% move. In 2008, the global financial system nearly collapsed. Confidence event. Gold doubled over the following 3 years. In 2020, the Fed printed trillions overnight. Confidence event. Gold hit new all-time highs within months. And right now, in 2026, you have a U.S. government paying over $1 trillion a year just in interest on its own debt. You have central banks globally choosing gold over U.S. Treasuries for the first time in 3 decades. You have a dollar under structural pressure. You have geopolitical fractures across 3 continents simultaneously. You have an American consumer whose purchasing power has been quietly eroded for 4 consecutive years. That is not one confidence event. That is a confluence of confidence events, stacking on top of each other in real time. And every single time in history that this many signals have aligned simultaneously, gold has not just moved, it has exploded. The signals are there. The pattern is clear. The institutions are positioned. The only question left is whether you are. If this video gave you a new way to think about gold, about the dollar, and about where your wealth sits in this macro environment, subscribe to this channel right now. Hit the notification bell, because the conversations we have here are the ones that actually matter for your financial future. Share this video with someone who needs to hear it. Drop a comment below telling me what surprised you most. And if you want a deep dive into exactly how to position in gold, which instruments, which allocation, which entry levels to watch, let me know in the comments, and that video is next. The signs were always there, now you know how to read them. How to